Get this. Oh, let me post this while I got a couple of minutes here.
In a joint statement, Japan agreed to up to $73 billion in US investments in small modular reactors by GE Vernova Hitachi, as well as natural gas generation.
Any interesting earnings out here? Nothing, right? Gemini. Oh, FedEx reports today. That's why that thing was ripping. I didn't know FedEx had earnings today. Looks like FedEx, decent numbers. Stouter!
S&P 500 closes below 200-day moving average for the first time since May 9th.
The trading after hours? Oh, yeah, up 5 after hours. FedEx off the number. Who else reported? You, Amy? I know some of you track that name. A lot of jabroni names reporting. Gemini. How's everybody doing? Yeah, that's the buckle up news pending. Buckle up. Let me lower this too. Oh shit, I almost knocked that over. I almost spilled my coffee 4 different times here. You got a Piker insider buy in Salesforce. Just came across. 500,000. Maybe there's some more behind it. Yeah. What's the story, Struck? How's everybody doing? This market wear anybody out yet? Almost. Here's the FedEx number. Here's the CRM buy. Oh man, yeah. You know, it's funny though. The past 2 days, yeah, I try to catch it. Yesterday and the day before that, and Gatsangul. At least it finally moved a little. Today I played it twice in the morning and afternoon. I'm gonna play it again tomorrow. All right, let me get back to so I don't get lost here. Where are we gonna go? Indicators. We'll start there, I guess. All right, hold on. Let me lower that. Let me move this coffee out of the way. All right, here's what we're going to look at. We don't want to make ourselves any more dizzy. Again, we kind of talked about this on the Sunday night webinar for STEAMROOM members. You know, when you get into these corrective environments, you know, there's two things you want to keep an eye on and keep time frames in focus here, right? What we want to see, the ultimate goal, right, at of every correction, you kind of want to get that reset, right? We've talked about that on so many webinars where you want kind of that complete cleansing, right? It doesn't have to be an abomination. You don't need a market crash. You don't need a bear market. You just, when positioning gets quite full, you want to see enough of a flush out or enough volatility. And that's what I think we'll talk about a little today, because it doesn't necessarily mean we need a whole lot of weakness or more selling in the equity markets. Could be just volatility, could be just frustration, right? You don't need that capitulation. A lot of times capitulation doesn't show up, but the market wears people out, you know, and especially when there's negative headlines around. So ultimately, like, that's the goal, okay? Because what I've learned from my experience, the longer you go without getting that full cleansing, that risk never goes away, right? Because you go through, like, for example, here, okay, and we'll get into the details of it, but like we could very easily see quite a violent rally off any positive news out of the Middle East. Right? We can all certainly foresee that happening. But at some point, if you don't get that full cleansing, once that rally runs its course, in other words, once those hedges get unwound, right? Once shorts get squeezed, it's very difficult to find the legs for a long-lasting trend, right? And even if you look in prior corrections, or even corrections that lead into bear markets, you really don't reach that bottom until positioning, you know, gets washed out. Okay. So the reason I'm even talking about that is that's goal number one. Like, that's what all of us, a lot of us who follow that's what we want out of this. Because that's the beauty of corrections. That's their purpose. Okay. But in the meantime, while we're waiting for that, because nothing goes down in a straight line. I mean, this market we're in, it's almost like a sideways, downward slanted menagerie we're in, right? That's basically what the price action feels like. But there are intermediate they find a way to squeeze bears when they're getting a little too excited or when they're a little too hedged, looking for further downside or concerned about further downside. The market has a tendency to rally over a short period of time and get those hedges unwound, squeeze those bears. Ultimately, after that, the selling can resume, right? Or again, more volatility can resume, but you look for those squeezes. So, and those squeezes can be very profitable if you can come close to timing them right. Right? They're not always that easy. They're actually pretty difficult at times to find the perfect timing as far as entries are concerned. Okay. So that's basically when we get into this period, those are the two ways that we look at the market, right? For opportunities on the long side. The in between all that is even that much more difficult, right? Because the opportunity names are a lot slimmer. If you're in chop like we've been, there's really random moves all over the place that you got to get really lucky as far as timing is concerned. So those are the two things we want to be focused on in a corrective period like we're in right now. Okay. So that being said, and we'll look at some of the things. Again, there are signals that back up. I'm not just pulling stuff out of my rear end and giving you gut feelings. You guys know how I feel about that. We'll look at the data and the indicators and signals to justify why we feel this way. But as far as a full cleansing is concerned, we're not there yet, right? We're not there yet. We've done a lot of work, okay? Especially, the indexes holding up obviously a lot better than the underbody of the market, right? Certain pockets and sectors of the market. It's been more of a rotating correction, right? It's been going from sector to sector, more so than everything at once. And that prolongs the process. Okay. So as a whole, where we're at now, we're just not quite there yet. Okay. We're a lot closer. I really don't think we have a ton of time and more damage left to be done before we get to close to where we want to get to. Now, that being said, again, there may be a rally, right, before we get there that certainly can prolong the process. That's what's so difficult about trying to predict how long it may take. All right. Depending on what happens in the interim means a lot. But I think the more important point is we're not there yet, and we'll look at the reasons why. That being said, we are at a point where, on a shorter term basis, we're in a squeezy environment here, where, again, a lot of the things we look at are telling us there's a higher probability of the market squeezing and unwinding hedges here than or before there's any further selling. Okay. And so we're seeing some positive signs regarding that. Okay. So that's where I'll start things off. And that being said, right, and you probably, if you were in the steam room this week, you know exactly what I'm talking about. On top of all that, right, as difficult as it is, this game, you go through periods of time, right? Earnings season. You've heard me, a lot of us complain about that. OPEX week is right up there with everything else as far as confusion, mixed signals, and things not working the way they should be working. It's a messy week, especially when it's a big triple quad witching type of OPEX. Okay, a lot worse than your normal, obviously, weekly OPEXs. So we got a pretty big one this OPEX with March. And not only size-wise, even just the course of the week here, a lot of rolling. You guys, I showed some of the blocks today. You're going to see some of the blocks going off out there, right? Now, again, some of it's rolling. Some of these are blocks we see from time to time on the put side, $40, $50 million blocks, okay? Non-directional stuff that I generally completely ignore, but it just adds to the messiness of things, right? It keeps things choppy. It could keep things on the soft side, on the weak side. But from my experience, again, I don't have the exact data to back it up. We talked about this earlier in the steam room, but just again, memory, right? Me remembering these type of things. when you're seeing some positive signs during an OPEX week and they're really not coming to fruition, the very next week, magically, when you get out of OPEX, you start seeing it resolve in a sense. You know what I mean? So that being said, here's what I mean by that. One thing we're seeing, okay, is on the credit side of things, okay, and more so our credit indicators than some of the other major ones like credit default swaps and stuff like that. But we've looked at, kind of the credit indicator we look at in the STEAMROOM on a day-to-day basis, and you can see a different look here, right? If you remember the last few weeks, what we've been talking about is this rolling over and equities not really following. Okay. And that's what gets me worried. Okay. I think it was Sentiment Trader posted something on X that I wouldn't say viral, but got a lot of looks. Was that there's only been like 4 times where credit spreads have widened out and the market equities didn't sell with it in a certain amount of time. And those led to bear markets as opposed to corrections. So again, I'm just making the point. Hopefully, again, this is the one time it doesn't. It's a small sample size, but I'm just making the point of how concerned a lot of us get who follow this stuff when credit is signaling one thing and equities are ignoring that signal. Okay. So what we've seen now is we've actually seen equities come in a bit, right? They've been playing catch up to kind of the credit signals we look at. And over the last couple of days, what we're seeing now is bullish divergence. Okay. Now you can see it on this chart, pretty obvious here. Okay. Equities have made a new low in a sense, right? Yeah, I think it's a new low, depending on what index you look at, but it has made new lows. And you can see that our credit indicator has shown some relief. So that's what I would look at as of right now as the short-term opportunity that goes alongside right now a lot of other shorter-term sentiment indicators that we look at, breadth indicators that are telling us there's a higher probability of a short-term squeeze here than usual in simple English. Okay. But again, this is a promising sign. Now, we talk about this all the time, right? Depending on what type of trader you are in this environment, how aggressive or how conservative you want to be is how you would look to take advantage of something like this. Okay. What I've done is I've actually not just I looked for a squeeze twice today. Today, I was fortunate enough to make some money. I caught a squeeze in TNA in the morning, and I caught a squeeze in the afternoon that a lot of you guys are talking about. That was a more meaningful squeeze. Okay. But yesterday, I did the same thing off some bullish divergence, and the squeeze just never showed up. It literally was a dead heartbeat in equities. I think what was it, the whole afternoon while credit was showing some bullish divergence. And even on yesterday was Wednesday, right? Even on Tuesday, right? So this is the third straight day I played. I was even looking for a squeeze on Tuesday. More so, it wasn't that credit was diverging, but credit was doing okay. But internals were washed out, and some of the sentiment measures were washed out, right? So I was looking for a squeeze for the past 3 days, including today. And it really didn't show up, right? Nothing major anyway. So the way I'm looking to take advantage of it right now at the current time is on an intraday basis. Why? More so because I can manage my risk a lot more efficiently, right? I don't have to worry about what happens overnight, what Trump may do, what Iran may do, what happens while I'm sleeping and I wake up to a complete debacle. You understand? So it takes that risk out of the equation. Now, it also takes out that reward, right? I could wake up to a ceasefire or some good news out of the Middle East, and, ES futures are up 100, right? And I completely miss out on that. But, for me, on a risk reward basis, the intraday is more appealing for me now. Okay. And more so, the reason why is if these were bigger picture signals, like if we were seeing bottoming signals, kind of what I was talking about at the start of this webinar, that would be a different story, right? Because I'm willing to take on water if I'm early, because again, I'm not just looking for a squeeze, I'm looking for a floor in a sense. Okay. So where I'm at now, and I've been in the game a long time, I don't have too many brain cells left. I don't like to be stressed. You understand? I'm in my rocking chair compared to a lot of you guys. That's the way I approach it. Okay. Some of you may be different, some of you may not. Okay. That's all up to you and your risk appetite and so forth. Okay. So that's what we're looking at right now, right? Where we're looking to try to catch this squeeze in a difficult environment. And I think, again, with OPEX is making it that much more difficult. Now, we go tomorrow into Friday OPEX, and I'm telling you, I'm going to look for, especially if we get more, if credit is holding up well and we got equity weakness, I'm going to be looking to find an entry to play a squeeze, no doubt, okay? But at the same time, you got a ton of pinning action tomorrow. You got to forget about it. Tomorrow's going to be a shit show. All right. But I'm prepared for that. And if the market if equities don't cooperate and we chop around or I get stopped out, so be it. Okay. But it's worth the risk, in my opinion, especially on an intraday basis. Okay. So that's how I'm approaching it from that standpoint. Okay. So, and the other thing I want to talk about, right? So this is a really positive sign. Whether it's just short term or not, time will tell. Okay. Because here's what I mean by short term. If next week, let's say we do rally. Okay. Let's say we rally tomorrow, Monday, Tuesday. Okay. Equities follow suit. But then at that point, credit starts to roll over again, right? As equities are rallying. Then it was just a short-term signal, right? Because credit's kind of been in this lower top environment since that October blow-off top we talked about in a lot of things, right? So this has been signaling chop to slightly bearish for a while now. This is just a short-term opportunity where we're finding some bullish divergence in there. Make sense? I don't want to make people dizzy on here. Okay. So there's a shorter term signal and a bigger picture signal. I mean, bigger picture, again, we want to see this. We would love to see bullish divergence, period, on a bigger scale. But at the least holding up better. What we don't want to see is this rolling over like that. Okay. Because the term widening out, when credit spreads and credit default swaps are widening out, equity markets are not going higher. Okay. And even if they do find a way miraculous to go higher, that's a debacle because we end up paying the price. It's even a bigger problem. Okay. So the last thing you want to see if you're looking for any sort of relief rally are credit spreads widening out. Most of you are aware of that. The other thing that, again, I don't want to get too glued to, especially because you get into environments where VIX and just volatility in general can end up flattening out. And it doesn't necessarily mean equities are off and running. All right, we kind of saw a little of that in 2022. So if we are going into some sort of bear market environment for however long, again, if we are, we can certainly see where an instance where volatility may have topped out, but equities aren't done yet. Right? So I don't want to get glued to these volatility signals at this point. Again, they're really efficient for what we were using them for, right? Kind of early warning signals and squeeze signals. But on a bigger picture time frame, again, I don't want to get glued to the volatility stuff. But what we've been seeing and what we've been talking about, as many of you know, is as equities were holding up well and making a new high, this was telling us a completely similar to credit, telling us a completely different story. Okay. Now, what we're seeing now is, again, a little bullish divergence here, right? You can see equities caught up a little bit with the rally, but you had, this is inverted VVIX. You had VVIX down all day today, VIX down all day today, and equities were at the lows at one point. Okay. So very similar to credit, big picture, still, no change, but you got a little bullish divergence here to go along with the credit stuff we're looking at. Okay. Here's correlation. Again, for what we really were paying attention to has kind of come and gone, right? We were dangling down here, which was a warning signal. If you remember, we talked about, it's like going out there, stepping on a landmine, because every time you get down here, the market rinses, and you can see how much this has moved since then. Okay. We are getting really close to April Liberation Day lows in implied correlation. All right. That's good and bad. Okay. The bad is, while this is happening, equities are going to pay the price. All right. So while correlation's increasing, equities are going down together, or more so are going down together. Is basically what it's signaling. Okay. That's the bad news. The good news is, once it tops and rolls over, and especially if that aligns with a lot of positioning and sentiment stuff we're looking at, that is a huge runway and tailwind for the other side of this. All right. So if you were around in April, same thing we were talking about. Okay. But that's generally all we're looking at here. Because again, what we were paying attention to more so from this indicator has come and gone now. Okay. We wanted to see this get up here in this neck of the woods, because the more we hung down here, the less steam we would have, even if we did bottom. So this is good. This is exactly what we wanted to see here. Okay. Financial conditions. Now, again, you have different type of financial conditions indexes out there. Goldman has a popular one, Bloomberg. Some are a little different than others. Okay. So this one we're looking at here is showing more tightening than the Goldman Financial Conditions Index does. Now, I think the reason why is the Goldman one, if I'm not mistaken, I think has more of an equities weighting in there. So equities, if equities are selling off, they play a part in tightening financial conditions in their index. And I think this is less so. I think, again, that's what it is. But as you can see, very similar to the correlation, financial conditions have tightened quite a bit here from where we were. Okay. And this is why you're seeing that whole cyclical trade that looked great. We were wondering if we'd ever see a pullback in, right? How these things were ripping all over the place has completely unraveled here. Okay. Because you have gone from extremely loose financial conditions, simply put, that screams buy cyclicals, to now aggressively tightening financial conditions, which screams sell cyclicals. All right, so that's how drastic it's been. So what we're looking for here is, there are a couple things, as we talked about. When financial conditions get up into this neck of the woods, usually it gets the attention of the Fed, right? Or something ends up cracking or breaking out there, whether it's in the credit markets or the economy, because financial conditions have aggressively tightened, right? Because if you think of the makeup of financial conditions, the dollar, energy prices, interest rates, if you have aggressively tightening financial conditions, that means you have a big move in these things on a short-term horizon. And that can create problems for a lot of different things. Okay. So what was interesting, you had the Fed meeting with Powell just yesterday, and the problem for me was, maybe I could be mistaken, but I didn't hear credit or really financial conditions be brought up once. I didn't hear not one reporter ask about it. Everybody was asking about the war and inflation. Every question, the same questions over and over and over again. Okay, but I didn't hear him asked about credit in some of these private equity banks and stuff like that. I didn't hear any financial conditions questions. Okay, I do remember him saying that he felt the Fed was in the perfect spot, that they weren't looking to raise rates now because things were slightly on the tighter side. And he's referring to financial conditions. In other words, financial conditions have tightened here enough to where they feel they don't need to raise, even though you may get like a little inflationary shock from this war. That's the only thing I heard. Okay? Only thing I heard. So why is that important? Because when credit and financial conditions, when they get to a certain area, okay, so when credit swaps widen out to a certain area, when financial conditions tighten to a certain area, usually alarm bells go off at the Fed or the Treasury, and they take some action because obviously they don't want something to break. Okay, if you remember in like the 2022, 2023 bear market, you had a couple things, right? You had the UK gilt market. It had problems, and the Fed had to stop tightening because of it. And then you had the SIVB debacle, right? And something had to be done about that. Okay, so while this same thing kind of with credit and everything else, while this is going on, it's just not bullish. It's not bullish. When financial conditions are tightening, the equities are going to find a really difficult time trying to find any headway on the bullish side. All right. But again, the other side of this usually comes with some sort of action that gets financial conditions to ease aggressively. Right. So that's what helps the other side of these type of debacles when you get in market wise. All right. But as you can see here, we're still up into this neck of the woods. Now, again, tomorrow, Monday, Tuesday, financial conditions may ease a bit and we get an equity rally, right, on a shorter term basis. So this has really not talking on a short term time frame here. I'm talking more big picture in regards to this. The put the call has been interesting. Today, because of this OPEX week, all these blocks I've been telling you guys about, that enormous blocks that have been going off, it even skewed the put the call. So because of all these kind of R blocks that have gone off all day today, the put the call elevated nicely. All right. Now, again, it's a fugazi move. If you guys know what I mean by saying that, right? It's not a real move because it's not based on players or funds betting or hedging downside. These are non-directional blocks that are going off that are skewing the volume ratio of puts to calls. Okay? So it's not a legit signal. That being said, from my experience, it doesn't matter. Okay? Because there are enough people out there who follow the put the call that when they see it elevated, contrarians, they just look to buy shit. All right. So from my experience, even if it's not a clean move in the put the call rising, it's helped the market rally on a shorter term basis. One case in point is this here. This was not legit. This major spike here, big outlier, was not legit. As a matter of fact, I think it came on an up day, up a little bit on that day, if I remember correctly. But, you saw everybody talking about the put the call on social media. Anybody who follows it looks at it as a big contrarian signal, thinking everyone's panicking, and they buy equities. All right. So again, on a short term basis here, you got to put the call elevating here, which is always good to see, right? We're coming from an extreme low here, And we've made a lot of headway here, right? We've cleansed a lot of the speculation in the options market, to state some of the obvious. Okay. So that's where we stand there. So those are some of the key measures we've been looking at on this webinar. Just to flip through a couple of other interesting things. Here's kind of a short-term indicator we look at. I've shown you guys. Coming into today, we're at basically, let's call it 7. Anywhere under 10, we like to look for a squeeze. Okay, so we're getting this alongside some of the other things like credit that are signaling to us that we could see a potential squeeze here. Okay, again, under 7's a pretty good signal. Again, just a reminder: it's a short-term indicator, right? It's not as short-term as some of the others. It could lead to a multi-day, multi-week squeeze. Certainly possible, but this is not a big picture indicator. So what I'm getting at is, if the market eventually has some selling to do, I've seen this thing linger under 10 in real corrections. I've seen it go to 0 in real corrections. All right. But in trending or choppy markets, it's money, as many of you know. And even in corrections, a lot of times things can be squeezy, right? So a lot of times even in corrections, when you get short-term signals, you'll get a squeeze, but the squeeze really can't find any follow-through. That's usually what happens, right? So these short-term indicators, they linger on bull signal, right? That's usually what happens. Here's today's AAII. So little by little, all these bulls are getting chipped away at. Okay, you're not at contrarian bull signal yet, but you're getting closer. Here's another one. This is weekly advisor sentiment. Was pretty elevated off the October blow-off. And then, kind of hung up there and then rolled over here recently. So this, again, 0 is a bullish signal and usually a bottoming signal. The only time it's not is if you're in a bear market. Usually corrections, you get to 0 and that's the end of it. Okay. Here are credit default swaps, by the way. All right. So this is what they've been doing here. So, we're not there yet, credit default swaps, but you start getting up here into the 4s, and it's gonna be on everybody's desk. Everybody who needs to know about it is gonna know about it, and usually something gets done. If it doesn't, the market breaks something to make sure something gets done. These are extremely tactical signals. We're on bull signal. These are really, really short-term stuff. Here's didn't I post it? Hold on, what am I under here? Indicate, yeah, where is it? It's over here somewhere, right? Here. And this is kind of what lines up with internals too, right? If you look, we got more green on here. For those of you who've been tracking along, this is again breadth and internals. Okay, so some sectors more than others, you see a bit more green. But if you look at kind of SPY and the Qs, which is a broader measure, okay, 10-day, 50-day, shorter term stuff is oversold. Okay, we're not getting any major bottoming signals yet. Okay, just so you guys get an idea, like we saw last April of last year, right? That's when you see, like the panic composite light up green. You see some of these longer terms. You see a spike in new lows. You see a more aggressive oversold type of market. But on a shorter term time frame, again, what this tells us is it's squeezy out here, right? It's squeezy. And let's see, anything else of so big picture wise, just quickly, let me show you a couple of big picture stuff. Here's the BOVA Fund Manager Survey that just came out. Comes out every month. Now we were up here last month. Okay, here's where we're at now. Now I'm not saying we have to get all the way back down to here again, but you would like to see more of a cleansing. More of a cleansing. Here is risk appetite, which has been a real pain in the ass to get, excuse my French, to get a rinse here. Just probably a month ago, we had a sell signal on here, which is rare. And the market was already off the highs chopping around. It wasn't like the market was ripping, but risk appetite was still too strong. And we're here now. Where does the market usually find a really nice floor? Under here. Okay, this is the COVID crash. So this is obviously an outlier. But here's the Liberation Day lows. Here's another bottom before that. Here's the 2022 bottom. The 2023 SIVB bottom. 2018. So you want to be down here in this vicinity. This doesn't always get there. I like looking at this on a weekly basis. This has a little bit of everything in there, from investor intelligence, bull bear, to CTAs, which we'll talk about in a second. But you kind of right here now. I would say we're a little below neutral as a whole. But this is the tough part is this, in my opinion. Once you get below neutral, even if you don't get further selling, even if it's just volatility, chop, and frustration that lingers, it bleeds it out. Because players get a lot more frustrated, right? They give up. Here's the Goldman positioning indicator. We finally flipped to the other side here. But where do these kind of high conviction floors show up? Down in this neck of the woods here. Whoop. We'll talk about Sharpies. Here are the riffraff specs, which we call them. So these are small specs in the futures market. Look how bullish they were, man. Look at this. They broke the chart. They broke it. It went over 100. So now you're down to 50. That's a nice wash already. That's a nice wash already. Would we like to see it more, closer to zero, the better? Sure. All right. God forbid they go short, even better. Even better. And it happens quick. It can happen quick. All right. So that's the riffraff specs. I got Sharpies here somewhere. I'll show you in a second. Yeah, I'm just flipping through some of these things. Here's a equity hedging indicator, right? Getting closer. Here's what I like to call a panic indicator, right? We're not really seeing much panic yet. The April Liberation Day low panic. A lot of you remember we looked at this on Sunday. Here's again another thing that keep things squeezy here, especially on a shorter term basis. The vol panic index is really elevated. So again, it could hang out here. So in other words, you get these like little drops and then goes back to a 10, then little drop back to a 10. But on a shorter term basis, when this thing is up near 10, you usually get squeezes. All right, so you had a 10 here, then you got a rinse, then you came back up here, right? You understand what I'm saying? So I wouldn't say this is a major bottom indicator. This is more of a short/intermediate term squeeze signal. Let's see what else. Here's another look at the panic indicator. Whoop, why do I keep doing that? Here's Deutsche Bank's big picture indicator. So this is a big picture sentiment indicator, a little below zero, right? A little below neutral. That's kind of how I feel on an average. Liberation Day lows here, most major lows down here. Okay. And so most of you understand, right? If the majority of these things are at or close to bull signal, that's enough. Like we don't need this thing to get exactly below the line, right? If everything else is lighting up green and this gets to close to a -1, that would be enough. But like we just crossed below neutral here on this. And here's the makeup. Now again, I make the point it could happen fast. Why? Because the makeup of this indicator takes in the two family of investors, discretionary and systematic. Okay? Discretionary never really all got bulled up as a whole, right? Hedge funds, they never really took the bait on the long side. They've been hedged and crowded in certain areas that have been smoked. All right? It's the systematic crowd that really got heavy-handed on the long side. Right? CTA, vol control, and they're the ones selling right now. Like you wonder, even like today or yesterday, what's putting pressure on equities, even when some things look bullish, CTAs are selling too, right? That's that tailwind that we enjoyed off the April lows throughout the whole rally. Now that wind is going and slapping us in the face. The complete opposite, right? So CTAs right now, and that's this blue line here. Well, these are systematic strategies as a whole, but because of where things stand, they now, because that trigger that we talked about, intermediate term trigger, that level breached, they go short now. So they're going from long to net short. That's the process we're in right now. Right? So they're going from here to net short. And again, problem for the market right now because it's extra supply. We've talked about that ad nauseum. But when this comes to an end, whether they're, if they're short or sometimes even max short, like they were the Liberation Day lows, that means where they're short and they can't short anymore. They're as short as they can possibly get. When that turn comes, oh boy, that's a force to be reckoned with. Again, off the April lows. Most of you remember that tailwind. It was stupid. It was so bullish, it was stupid. Okay? So if you're wondering, where do they get max short? Well, depending on what model you're looking at, it's right around, call it 6,500. 6,500? Let me double check that. Hold on. No, 6,400 as per Goldman model, 6,400. I haven't updated this one on this chart. 64, call it 20, right around here. So this is where they get to a point where they're max short. How come I can't make this a different color? Okay. So again, here was the intermediate term trigger we talked about, right? We danced around it a little bit, and as it hung out underneath it, it's really, it's not that all of a sudden the price action miraculously goes into crash mode, if they trade below it, now their flows tilt bearish. You understand? So now on a week to week, month to month basis, they are net sellers in every tape. Let me show you. This was the beginning of the week. CTAs, flat tape, US market dumping 35 billion. Up tape, if the market's up, dumping 18 billion. Down tape, dumping. So this is how the flows tilt, right? In a flat tape, they're dumping just as much as they would in a down tape. And into any upside, they're dumping half of that. Okay? So this was this week, coming into this week. Over the next month, flat tape, 55 billion bucks coming off their book. Up tape, 42 billion. Down tape, 48 billion. But look, this week was a big chunk of that, right? Oh, here's the max short trigger, 63.70. So a little under 6,400. Okay. So that's the story there. And here's kind of what they look like. Very similar. Again, they're different models, right? Goldman has their model. Nomura, McElliott has his model. Deutsche Bank covers it well. They have their model. Everybody's got a model. They're pretty close. Bova, most of them are pretty close. Here's global CTAs, not just US markets, everything. And this is US here. Okay. Again, this was last April, the bottom. All right. So like if you get them down here, again, it's not that the news magically turns bullish. It's that even if there's more negative news, the majority of sellers already sold. That's what puts the floor in. And then if things flip bullish, you know how that ends up. These are systematic funds. So these are CTAs, vol control, and risk parity funds all in one. All right. So that's the story there. Was there anything else I was looking at over there? Oh, I'm back here. Yeah, the rest is just indicators I think I just really like to look at. This is a flight to liquidity. So what happens is when markets run into trouble, when there's some volatility, weakness, people give up on stock picking. Okay, they want to go into the most liquid products. So they usually put money in ETFs. That's their only exposure. When it gets to an extreme, it's usually around bottoms, right? Because it's a measure of psychology and emotion. Here was the April Liberation Day lows. You had a massive flight to quality because Trump was going to break the global economy with tariffs, if you remember. Okay, we're here. Again, I'm going to put that disclaimer. I said I got a good 50 times already. It can happen quick. Once it starts moving, it can happen quick. As you can see, this is pretty quick. Here's another indicator I love, and then I'm done with the indicators. The sentiment cycle, or panic indicator, I like to call it. Most of you remember this one. This was one that was the kind of the cherry on top of everything, the April lows here last April. Again, can happen really quick if it wants to. Right? You look this low. Here's the bear market in 2022. You had a couple floors put in there. The major low it caught. This low here, COVID. 2019 low. 2018 didn't quite get there. 2016, the Bazooka Joe bottom, as I call it. Again, this green line, you get close, right? You get up to here in this neck of the woods, that's fine. That's fine. Oh, I didn't show you Sharpies. Let me show you Sharpies quick. Sharpies, would it be under indicators? Yeah. Hold on. I think Sharpies are over here. Oh, I went too fast. What'd I do? Here we go. Here are Sharpies. So Sharpies are, we'll call them flat, slightly net long index futures as a whole. Okay. Again, Sharpies are by himself. You see, I'm not bad, right? I got a handle on it. Sharpies by themselves, you want the extreme if it's by itself. So in other words, what I'm getting at is if you don't have bottoming signals, if you don't have those strong floor signals we like to look at, you got to be careful. Because again, I got caught. I'm telling you from experience. Here in 2022, which was a bear market, so it is different. But here in 2022, Sharpies covered their hedges. Okay. And, this was the low here. The market rallied and completely rolled over. Okay. As you can see, as that happened, they flipped from slightly net long to slightly net short. But then as the market came in, okay, look how aggressive they got. So like this is the extreme buy signal when they get aggressive like this. And then this here, as many of you know, I think was the even better bull signal because it wasn't even the bear market. It was after we bottomed, SIVB. The market wasn't even selling off that much, but because of how bearish everybody got, this was rare for them. To get this aggressive and then add is really rare, as you can see. Okay. So again, good news that they've already taken their hedges off. Why is it good news for me? Because even if there is more weakness left, they're likely going to add into that. And then you got the Sharpie crowd aggressively long equity futures again. And there's no better class of investors you want to be alongside aggressively long than Sharpies. Even if they're wrong, you'll lose your money being on that side of the fence than being on the other side. Right? So that's the good news from Sharpies. Here's another. You can see how many I look at. Risk appetite. I like to look at a lot of these things in corrections. Like when you're not in a correction, there's really no point in looking at these things. All right? But when you get into this type of environment, that's that's my bread and butter, looking at these things in corrections. Okay. Now, I don't want to make it sound like nothing in this game is easy. The problem is for these things to get to where we want to get them, it doesn't happen in a straight line. And sometimes rallies show up before they get there. You understand? So it wears on your patience. It can be frustrating. That's why we kind of like to look at things on different time frames, right? Like currently, where we were talking about earlier, right? On a shorter term basis, you got a high probability squeeze backdrop right now, right? Squeezy, as I like to say. It should be squeezy out there as we go into next week. Okay, that's on a shorter term time frame. So tactically, nice and easy. We don't want to bury ourselves because there's obviously risk because it's short term time frame stuff. But we want to try to be a part of a squeeze and make some money while we're waiting for those bigger picture, sweet spot, fat pitch setups, as we like to say. Make sense? Yeah, I look at Move every day. I track Move. The same thing. Like here, if you look, is this updated today? Ooh. This was the issue. Right? You had it starting to push higher before equities kind of sold off a bit. And now, it's like VIX now, right? It's like VIX now. I don't want to get glued to it. The correlation between Move and equities is not always great. Move is a bond market indicator. It measures bond market volatility. It's just over the last few years, it's been a good signal for equities. But yeah, that's the extent of it. That's the extent of it. I mean, listen, if we want to go into the weeds right now, we can go into the weeds, especially on the macro side. That's where I try not to get too wrapped up in, even when shit's making sense. Like right now, and you guys know I don't always feel like this. Like it makes sense to me what's going on out here. You understand? Obviously, a lot of people feel the equity indexes should be lower, but the equity indexes aren't a great measure of equities anymore. There are places, they've been places to hide out in, especially now where there's stuff, it's not just cut and plain vanilla. The tech sector's strictly tech. There's a million different types of tech, right? You got software, you got AI, you got AI optical, you got AI this. So some parts of the economy are still seeing pretty impressive growth. But again, what we were talking about, like the risk to the cyclicals, which were they were under-owned October of last year. Okay. We came into this year where they aggressively chased those cyclicals. You remember that, right? You had names like Freeport and Alcoa and all these names. They went bananas, right? Not to mention silver and everything else. The risk, though, was that if whatever it may be caused financial conditions to tighten, that cyclical trade becomes from a screaming buy to now you want nothing to do with it. And that's what's happened. So basically what we need now for cyclicals is this climate that we're in right now, okay, to create a growth scare, not an inflation scare. Okay, that's what it's been so far. It always is early on when you got geopolitical events and oil screams higher. There's always an inflationary shock scare, right? But what usually happens is that inflationary shock leads to a growth scare, okay? And a growth scare will likely bring the Fed and stimulus back into the equation and financial conditions to loosen. And that's the backdrop to own cyclicals. We got to get there. But the risk to cyclicals that we were worried about, right? That was the risk. If you chase cyclicals up here after they ripped already, if financial conditions start to tighten, you're going to get hit over the head. So that risk now has happened. It's, you know what I mean? It took place. Now, ultimately, what I'm hoping happens is what I just explained to you guys, right? What we don't want is the inflationary picture to play out, because that leads to rate hikes, and that's case closed. We got problems. There's, again, I wouldn't say there's no playbook for it, but it's a limited playbook. And risk assets, you know, you got to be, again, bull markets, they come to an end when the Fed pops the bubble. Usually it takes the Fed doing. Like, can you imagine, like, do you see this? Can you imagine if the Fed has to raise rates here? I mean, have you looked at some of these rate sensitive places? Look at this. Housing. Look, this thing was at new highs breaking out. Look at this. Whoop. Right? What's the other one again? The construction one? Oh, XH. No, that's the home builder one. What's the this is what I got up. What's the other one? I keep forgetting it. Anyway, all the cyclicals. Yeah, again, a transitory, you know, I don't want to sound like a Fed member here, but yeah, basically. You know, it's just a, you know, you get a pop in oil, and it's not always sustained. Now, again, some are, and if it is, it can become a problem. Okay, the difference between now and 2022, the Fed wanted it to happen. The Fed pushed it to happen because they were battling inflation. That was their goal. You understand? That was the goal of the Fed. Tighten financial conditions, raise rates so they can kill inflation. So they can take risk assets lower purposely. It was a rigged game to the downside. Okay, now Fed doesn't want that. Trump doesn't want that. You know, but the risk is this geopolitical shit. Some could end up that way without you wanting it. That's the risk, right? When you whack the hornet's nest, that's what happens. You don't know what the outcome. You're not guaranteed of an outcome. So if the end result here is World War nuclear holocaust, and Jesus is on his way, then, you know, we got problems. Doesn't usually happen that way. Is it possible? Sure, anything's possible in this fucking world. Excuse my French. Okay. But again, you know, the macro stuff, don't get me wrong, you guys know, I don't want to get stuck on the macro stuff, because here's the problem, okay? And I'm admitting it. I'm not denying it like most will. In 2022, okay, in the 2022 bear market, if you got hung up on the macro stuff, you missed everything. Okay? Because the macro backdrop coming out of 2022, like, listen, this was the most telegraphed bear market ever in my lifetime. Ever. The Fed rigged it to do that. Okay? But what happened here is because everybody knew the playbook. Everybody knew what was going on. Okay. Everybody felt and was positioned the same way here. You could even say this, even in my opinion, here. Already in that low. Okay. Into this low, everybody, everything, anything you can look at was bearish. Okay. Because what you had the Fed aggressively, purposely tightening, battling inflation, and saying that they were going to continue to do it. They can't stop. They got to keep the foot on the brake because inflation's a problem. You remember all that. And everyone, including me, thought that, wait, this is the most aggressive tightening cycle ever by the Fed. Okay, ever. I mean, it's almost guaranteed we're going to get a recession out of it. They're trying to get a recession out of it. Right? So here, everybody was betting on recession. Here, everybody was already counting their money that equities were going lower, betting on a recession. But that floor was put in because of that. And then a couple things, the credit market in the UK cracked. The Fed had to take the foot off the brake a bit, right? Little by little, the Fed had to stop or slow down the tightening and started to build some upside. But nobody believed it. Nobody believed. You remember that rally? No one believed. You could, even if I guaranteed you was going higher, it was hard to believe. So the moral of the story here, guys, is the macro stuff ends up doing for me more damage than good if you fall in love with it. It's the most difficult stuff to predict. How could we not get a recession, guys? How could we not get a recession from what the Fed did basically all of 2022? We still haven't had a recession since, which is nuts. Okay? You know how many macro playbooks this ended up ripping up because of it? So many economic indicators that people swore by, macroeconomic indicators ripped up. Useless. No one's ever going to look at them again. So many. So many. You remember hearing the terms. And again, because nobody was involved, right? Just think about it. CTA short, specs in the futures markets, max short. Everybody you can possibly think of, any facet of positioning and sentiment, completely washed out on extreme contrarian bull signal. Every single one. And again, I'm not even telling you nailed the exact lows because they showed up here into this summer low. And then you had this retest and a little bit of a break. So anybody who thought maybe, okay, as a contrarian, I'll be bullish, they second guessed it. You know, again, this upside wasn't easy. The chart doesn't even do it justice, right? This here felt like a disaster. This, right? Druckenmiller was predicting sideways market for the next 10 years. Druckenmiller, okay? So, but that's why a lot of us want that floor. You understand? That's why a lot of us want that floor. That cleansing, that full cleansing of positioning. Yeah, he got his own. He got his buddy in there. He got his buddy in there. Yeah. Only Tom Lee was the only bull. But then again, when is he not bullish? Right? When is he not bullish? Oh man, it ruined people too. Kalanovich, Marco Kalanovich was the top analyst on the street. Still to Marco Kalanovich, he's a sharp guy. You know what I mean? He knows his shit. This ruined him. Ruined him. He stayed extremely bearish throughout. To this day. To this day. Mike Wilson. I don't know if you remember Mike Wilson back here. When Mike Wilson popped from Morgan Stanley, popped on CNBC or Bloomberg and shared his thoughts, everybody listened. He stayed bearish. Eventually, he capitulated somewhere up in this neck of the woods. Yeah, Mike Wilson bears throughout this whole thing here. Back here, Mike Wilson used to be called a perma bull. How about that? Some of you probably don't even remember that. Okay? He was called a perma bull. But 2022 ruined his name. He's found a little bit of a footing again. But the point is that everybody based off macro, handicapping the macro thought there is no way equities can rally from here. There's just no way. No matter how bearish everybody is, it's just data. You understand? If a recession's coming, we need to see it come before you can get bullish. Right? You need to see the recession at least start before you can get bullish. You don't know how bad of a recession it's going to be. It wasn't like the Fed was cutting rates. Right? The Fed wasn't easing. There was no QE. There was no nothing. No nothing. But, that's how it usually goes, guys. The outlier is 2007, 2008, as you guys know, where the global economy was brought to its knees because they let Lehman go under. But again, listen, we'll see ultimately how this plays out. Who the hell knows? Does it take more downside? Is there going to be a rally before there's more downside? Is there just going to be volatility and range-bound action? Right? That's basically what we've had so far. People are comparing this to 2008. What are they on crack or what? They obviously weren't around for 2007, 2008. They obviously weren't around. You were still in school in 07. All right? Good for you. You were better off. But trust me, I was here for 2007, 2008. Okay? This is not 2007, 2008. Not yet, anyway. Not yet anyway. And you got to understand the froth that went into it. There was a lot of different things that went into it. A lot of different things. So yeah, I'm not, again, I don't know how this resolves, but ultimately I hope we get as close to those floor type signals as we usually see, because that's just a great floor to build around. You know what I mean? Doesn't guarantee you're going to have a rip roaring bull market on the other end. A lot of times it is, but even if it's just a floor, that's where you feel comfortable starting to buy stuff, collect things, as we like to say, right? Start collecting longs on a longer term time horizon. Right now with the damage out there and a lot of things, it's hard not to make that argument now. But the problem is, as I've showed you guys, if we're going to get to that floor, if that's ultimately where we get to as far as positioning is concerned, there's still room, right? There's still room for damage. Now, again, it doesn't have to be as much damage as we fear, but that's the risk. That's the risk. I think personally, just based off what we're looking at now, it's probably just going to be volatility and range bound market that gets us there, unless there's a shock, right? And the reason I say that is because this has been so orderly and slow that, like, for example, where we're at now, people are hedged. People are already hedged for that. The pain trade, as we've been talking about, okay, what everybody was positioned for here, everybody was buying names, individual names, right? Buying Mag 7 AI names and buying SPX puts and VIX calls. That's basically how every fund was positioned. This slow train wreck has been the worst case scenario pain trade for everybody, because those SPY puts can't make any money because it's been so slow, and the names they're in got hit over the head, right? If you own Oracle and you hedged Oracle with SPY puts, you likely lost money on both ends. So this has been the ultimate pain trade right now. And that's why I think this can linger. It can certainly linger. And it lingers to the point where everybody's so frustrated and disgruntled that they're fully hedged, but they don't want to own anything because they can't make any money on the long side of anything, right? And that's where you get to extremes on the positioning side. All right, so even though the market's not falling apart completely, people are still getting very cautious because there's no upside. And especially if the news and the environment is spooky around us, right? So, again, we'll see how it plays out. In the meantime, we look for tactical opportunities. So, like right now, try to catch a squeeze, nice and easy, without killing ourselves. If we build some constructive momentum here, we go into next week, non-OPEX week, we start to see them sweeping up some calls in individual names, right? Maybe we got some short-term trade opportunities in select names that they're buying. If the market starts to bounce a little bit, so we try to pick up a little money on these short-term unwind phases while we wait it out. But we don't want to go overboard on it. We don't want to go crazy, right? Where we want to get aggressive is when we get what we're looking for here. We're just trying to survive, make a little bit of money, and it allows us to be patient in this process. That's what it all comes down to here, right? Is just being patient. So hard for us to be patient, even though we had this we just came off of, where we're all doing cartwheels on the long side and everything you can possibly imagine. We can't wait out this. Can you imagine? Yeah, bad, Ed, right? Like, think about that. Look what we just came off of. Talk about V-shaped rally. Look at that. That's like a check mark. And we can't wait this out. We're complaining. Look. That's what we're complaining about. It's incredible. It's incredible. Yeah, again, you're predicting, right? You're predicting how that's going to shake out, right? The subprime crisis. I mean, ultimately, again, they let Lehman go under. That's what the debacle was. Because once Lehman went under, they smelled blood everywhere. If you're not going to bail out Lehman, you're not going to bail it out. You got so many other banks that are in bad shape, they're dead. So they started to go after all the others. If Lehman got bailed out, it'd be a completely different story. You're talking about pre-QE days, guys. You're talking about a time, it's almost like prehistoric, before the Fed started rigging the game. If things start to crack, that's my point. Okay, I agree with you. That's what we were concerned about a month ago. Over that, a month and a half ago, was that we were starting to see signs in credit show up a month and a half, 2 months ago. Now everybody sees it, including the people you want to see it that are going to do something about it. Okay, so that's what happens. Now, when this happens, they're going to take action. They're not just going to let it blow up. That's the difference. Now, if you're going to give me the rebuttal, there's going to be one time where the Fed is, what they do is not going to work. Yeah, maybe there's going to be that time. But if you're trying to bet on that time, good luck. Because you're probably 0 for your last 30. The time to get nervous was here. As the market was making new highs, credit started to tell you, okay, listen, be careful. The market's not as risk-on bullish as it looks. Now it's in sync, right? Even if the spreads widen out further, okay, yeah, equities have a little more downside, but then something's going to be done about it. Yeah, that's what this stuff is. Again, they don't predict; they just real-time gauges on the health of the environment. That's it, right? It's not predicting. Like here, this was the credit indicator a couple of weeks ago. Like, look at this rollover here. The market's at new highs here. Look at this. Right? Now, what we were talking about, and that's always the case. I'm not saying we're smarter than everybody else, but that's the value of these tools. What we're talking about, what we were talking about 2 months ago, now everybody's talking about. Now everybody's eyeballs are on. Right? Everybody. So, that's why, I'm not trying to predict the future. I don't, all I know is if things get worse, the Fed, they got to do something about it. Right? They got to put the fire out. They got to put the fire out. And before you know it, well, who knows now if Powell staying, going, whatever the case, the fiasco. But ultimately, Trump's looking to get somebody he's got a little more control over. Well, anybody other than Powell would be more beneficiary to him. But, just making these predictions is useless. Useless. There's no one in here, including me, that know when the next 2008 is showing up. Okay? I've heard it on every market pullback since 2008. We're in 2026 we're in, right? Yeah, 2026. Okay? That's 18 years. I heard we bottomed in 2009. There was a correction in 2010. I heard it was a replay of 2008. 2011, government shutdown. I heard it was 2008. 2013, Grexit. I don't know what the hell happened. I heard it was 2008. 2015, 2016, correction. I heard it was 2008. 2018, late 2018, the Christmas debacle. Mnuchin gets on the phone with banks. It's a replay of 2008. Oh my God, Mnuchin. All end up being the best buy signals you've seen in your life. 2019, Volmageddon. 2020, COVID, global economic shutdown. We're never coming out of our house again. Oh my God. 2022, the Fed is over tightening. The game is over. 2023, run on regional banks, SIVB crisis. 2025, Trump is breaking the global economic system with tariffs. You guys realize that or no? You see a common theme here? Markets correct. It's when they don't correct where we should get nervous. When markets don't have a correction, that's when you need to get nervous. All it's doing now is just testing our patience, and we got a range bound market for 3 months, 2 months, and people are pulling their hair out of that. It's all about patience here now. Waiting for that better backdrop, that cleaner environment to make some money. All right, my friends, I'm going to wrap it up. Another week has come and gone. And remember, it's only money. Enjoy your life. There are people blowing up in the Middle East right now. Bombs are landing on their roof. We're worrying about chop inequities. Right? Oh, my God. Sometimes you got to stop and think about things, really. As you get older, you'll see. Stop it all. Have a good night. Everybody, have a good night. Let's see tomorrow. Again, it's going to be a little difficult with Friday OPEX, but we got maybe a little weakness at the open tomorrow. Find a squeeze entry. Maybe they'll give it to us. We'll put our squeeze caps on, and we'll see what happens from there. All right, I'll see the most of you next Thursday. Steam Room members, bright and early mañana. Have a good night, everybody.